Well, good afternoon, everyone, and firstly, welcome to the Resources Roundtable. Thanks very much for joining us. Today's webinar is hosted by Market Matters and Shaw and Partners. So for those not familiar with either or company, we've got a lot of subscribers to Market Matters on the line, but perhaps if you're not across Shaw and Partners, I'll give you a quick rundown on both of those. Then we'll get straight into talking about resources, digging through some of the key calls that we've got on the resources space at the moment. I'm joined by a couple of analysts from Shaw. But just to give you a quick background on Market Matters, we're a daily investment newsletter. We write a daily note that's sort of direct from the desk. It's trying to avoid taking out the noise of the market and writing a pretty raw approach to the market. We've been going around 7 years. We've got a couple of thousand subscribers now. I'm also a portfolio manager at Shaw and Partners, and Shaw and Partners is a leading wealth management and asset management company here in Australia with about $20 billion of assets under management, so it's fairly sizable. Today I'm joined by two of Shaw's analysts, our head of research, Andrew Hines. So Andrew is joining us from lockdown in Melbourne. Thanks very much for joining us, Andrew. He's the head of research and also covers the smaller and mid-cap resources space. Welcome, Andrew.
Thank you, James. Glad to be here.
And I'm also joined in Sydney by Peter O'Connor. So Peter, commonly called Rocky here in Sydney. He's been on Market Matters videos a number of times, so he's probably well known to Market Matters subscribers. Peter's our senior resource analyst covering the resources space. So thank you very much for giving us your time today, Peter.
Good to be back, James.
Yeah, it's a today I'm going to give you an overview of we're going to start with the commodity, then we're going to dig into and give views around the commodity, then we're going to dig into the actual companies and opportunities within the sector. The whole idea of this webinar is to dig. I don't want to keep using the word dig because it's a pun and I hate puns. But try and unearth some opportunities in the resource material space, big and small, and give your views around what we're seeing in the market at the moment. Just a reminder to all that information today, just before we begin, is of a general nature only. So you should consult a financial professional before taking any information on board. It's general information only. And just importantly, stay on the line till the end of the webinar. Peter and Andrew are going to give their best buys right now, so it's a little carrot to keep you online for the full period. We're going to start off with the most topical area of the market, which is gold. We've had the questions that I've been asked today for this webinar are all centered around gold. So I'm going to get up a chart in a sec. But Peter, give us your thesis around gold: bullish, bearish, otherwise, why, and why is that the case?
James, bullish, unequivocally bullish, and it's one of the three key areas of the market that we see very strong, actionable signals. And it's important that this is not just a short-term view, which is typically the case in equity markets. So it's not about today, tomorrow, next week, or next month, or even next quarter. This view will run out for multiple quarters and likely multiple years. Now, the genesis of what we're talking about kicked off on the 23rd of March this year, right at the bottom of the current coronavirus meltdown and the share market abyss. And that was when central banks globally set about a concerted effort to set the world back on a framework to recovery. And the drivers of gold price from here, based on that inflection point, are fourfold, but I'm just going to touch on two. One is interest rates, but specifically real interest rates, so those that are adjusted for inflation. They are negative now, and when real rates are negative, gold price will appreciate and continue to appreciate. And that's how we see the world for at least the next couple of years to 2022-23. And the other one to think about, and this is what will drive tactically the gold price to new highs, will be the ETF flows. Not necessarily about value, but more about what I call a triangular flow of money into ETFs. But somewhere down the track, we'll see that very squeeze play out, and that will take gold to the new high. So and a template to think about is what happened in 2008 through 2013, post the GFC. Gold price went up somewhere in the order of multiple times, and it played out over a period of about 2 years before it peaked. And that's the journey that we're on now. And I stress it's a journey which is going to run out for both the gold price and gold equities.
So bullish gold. So we had a 2,075 high in gold. Obviously, we had a really bullish trend. Is this just the pullback in terms of sustaining a bullish trend? Is this a healthy pullback that we're having? We look at charts a lot. There's a chart of the spot gold price on the screen there for viewers. We're trading 1948 on the market today. Is this the next leg higher? And what's your ultimate target?
Absolutely, this is what I like to use a term. Gold is making fresh new highs, which James mentioned. It made 2,075 just recently. It's coming back and consolidating, making a fresh higher low, and that's the journey we're going to be on for the next 1-2 years. It's going to be a continual process of the fresh highs, fresh higher lows. So until rates become positive again, this journey will continue. So moving higher and opportunities to buy the dips.
Andrew, have you just bringing you into the conversation? So are you views in markets obviously have counter views. So things that may happen that would stifle your bullish view on gold. Andrew, is there, what are the risks around the gold trade at the moment that we should be conscious of? I get the backdrop is really positive in terms of where interest rates are relative to inflation, etc. But do you have any counter arguments that the risks that we should be across at the moment as well?
Well, not really, Joe. I actually completely agree with Rocky on where the journey is going. I guess that the key thing to watch in the next year or so will be how the world comes out of the COVID situation. If we do end up in an environment where vaccines come into the world faster than people think, and all this massive stimulus that's been put into the market from central banks around the planet see growth recovering quickly again, then maybe we're back in an environment where the interest rate environment comes back into something faster than we're currently projecting. But at this stage, I'm completely on board with Rocky's view on where gold's heading.
So what do you, Andrew? So what do you think around and Peter? So a vaccine. There's talk overnight that the US should be preparing for a vaccine November 1. That that's probably a really optimistic Trump-like timetable. But what happens when a vaccine gets announced to the gold price?
A vaccine is going to see risk on in equity markets, so risk assets will go up. So gold will likely fall, but again, that will be an opportunity it'll make a fresh higher low from wherever it's trading at, and that's an opportunity to buy it again. Guaranteed, all the print media, electronic media is going to say gold's over, it's all done, run away. That's the time you'll be looking seriously at topping up again, because again, it's about real interest rates and central bank policies, and they're looking at like the position they'll be for the next 1 or 2 or 3 years. Rates won't be positive for an extended period of time.
So that's the main call, that rates are lower for longer, and as long as that is the case, then gold's going to be well bid.
Yeah, the COVID, it'll be a noise and maybe multiple days or weeks noise, but it'll be opportunity.
Okay, so let's dig into some of the, I did it again, talking about digging, but dig into some of the picks in the space. Peter covers large mid caps in the space. Andrew covers some of the small caps. So I'll start with you. So Newcrest, we own Newcrest across our portfolios. I've got to say it's been a real disappointment in terms of the operational performance that it's delivered over the last couple of years. It looked like it turned around, but then the last update was poor. Should we keep holding Newcrest, and why not?
Yes, you should keep holding Newcrest. Yes, it's been disappointing the last 2 years, whether it's droughts or it's seismic events or it's grade and clay, etc. I could go through a whole lot of things, but I think largely those are behind. Now, in a mining company, operational issues are always somewhere around the corner, so we need to be aware of that. But it's more importantly their positioning. The company is now positioned for the next phase of its journey, and they learned the lessons from the last cycle I talked about in 2008 to 2013 when they did a major acquisition, and they're still nursing that now.
That was Lihir.
And now they've got mapped out in front of them 4 what they call tier 1 opportunities to take them forward. And they reached greater than 300,000 ounces per annum for at least 15 years life and a cash cost lower than $800 US per ounce. These are world-class assets in their portfolio, and they're advancing them progressively, and they should be producing from at least 2 of them within the next 2 years. That's the next platform for this company. Management's one of the best in the sector, both gold and mining generally in Australia. Their delivery, other than some of the operational hiccups, has been very good. Balance sheet can handle this, and their risk profile across multiple jurisdictions is fine. So I still like where they're going. They're cheaper of the major or mid-cap names, and globally they compare very well. So when people sitting in North America compare Barrick and Newmont and Newcrest looks cheaper.
But do they sit here and go, gee, Lihir's a really tough asset. They've had a lot of problems operationally with it. is it, can they iron that out? I mean, they've made a lot of improvements over the last couple of years.
It's a good question. To go back 5 years when the new CEO started, he used to run at a production rate of what they got 9 million tonnes of ore going through their mills to produce gold. It now does 16. That's the improvement. So is the last year a bit disappointing compared to the previous year? Yeah, it is a little bit because they didn't do 16 million tonnes again. They did 15.5, but they're doing 60% more than they ever thought was possible. And that's critical because the returns on capital are better. The opportunities are better to go further. So disappointing in the very short term, but directionally favourable.
All right, so maintain the bullish view on Newcrest, valuation, operational improvement, gold price tailwind, and the like. What about in the mid cap space, Evolution, Northern Star, more upside there, or do you see Newcrest has got the gold price tailwind and they can actually get a further uplift if they improve operationally as well?
James, the short answer, in the environment I've mapped out for gold, you buy anything. You almost don't need to differentiate. When we start to fine tune, that's getting quite cute. But at the big cap end, there's some really good stories. In fact, the balance sheet's the best it has ever been. The M&A activity of all the majors has been the best it's ever been. Nobody has cocked up yet. And I make that point because people typically do, as Newcrest did last cycle. And their growth profiles all look attractive and their cost base look interesting. For me, the standouts other than Newcrest would be Evolution. They had an investor day this week and mapped out some really interesting plans for their assets. But their peers, Northern Star, Saracen, a great opportunity at the super pit in WA. So again, I'd almost be happy with buying a portfolio of any or all because they're all going to give me the same tailwind with just slight nuances about operations. So I'm well placed, but I had to pick two. I'd say Newcrest definitely. I'd probably be thinking more towards an Evolution now, given what I heard 2 days ago.
All right. So maintain the range. Andrew, bringing in the smaller end of the market, what are you seeing in terms of the more speculative area of the gold space at the moment? What are your picks in that area?
Yeah, look, I'll give you three names which are at different ends of the spectrum. So I'll give you a producer, a developer, and an explorer. So the producer that we like at the moment is Ramelius. Ramelius has obviously had a really great run in the last 6 months. So at $2 a share, it's not as cheap as it was when we were first looking at it, down around $1. But it's very well managed. It's one of the few with a growth profile, producing around 230, 240,000 ounces of gold per annum at the moment. They've got a pathway to getting towards 300,000 ounces of gold over the next couple of years from their assets in WA. Very clear strategy. They're acquisitive. And they're following in the footsteps of some of the majors. I sort of think about Ramelius as being almost like a smaller version of Evolution from a few years ago. So that's the pathway that they're following, gradually climbing up the scale of assets and buying stuff sensibly and disposing of things as they no longer fit the portfolio. So Ramelius for a producer.
Sorry, Andrew, the size difference of a Ramelius versus an Evolution? What are they market cap wise?
Yeah, so Ramelius market cap at the moment is about 1.6 billion. Evolution, Peter, what's
close to 10?
10.
Yeah, so it's a factor of nearly 5 to 7 times larger.
Okay, great.
But the developer that has caught our eye, it just looks astonishingly cheap, and it's because it's a PNG exposure, is Geopacific. So Geopacific are developing what's going to be a 100,000 ounce operation on Woodlark Island in Milne Bay, just east of PNG. And they're in the final stages at the moment of getting their financing in place. We expect them to have all that done by the end of this year. First production in 2022. And at current gold prices, I mean, they'll be producing at an all-in sustaining cost of about $1,000 Aussie per ounce. The $8 gold price at $3,000 an ounce, almost. So $2,000 an ounce margin. They'll be producing 100,000 ounces a year. So the numbers there are huge. A couple
Andrew,
hundred million.
Just on PNG there, doesn't the market have a real dislike for PNG, a distrust for PNG, given what's happened to some of the other companies that have operated over there?
Yeah, there are certainly some concerns about resource nationalism going on in PNG. You can see that with the oil and gas projects, and you can see that with what's happening with Barrick and the Porgera project. I guess our view is that the PNG government is clearly sort of restaking some ground here around the relationship they want to have with the resource sector. And they have picked some fights with some pretty big players to reset that ground. What they also want to see happen, though, is they don't want to have the doors closed. They want to see new money coming in. They want developments to go forward. And something like a Geopacific would actually suit their purpose very well to get that project up and going as a signal to the market that PNG is still open for business despite those other concerns. We also note that very preeminent Papua New Guinean has just joined the board, and I think he's going to navigate through that geopolitical situation pretty well for them.
Sounds sensible. What's the next junior?
And then the exploration play that sort of caught our attention recently is Matador in Canada. So Matador Mining, MZZ's the code, and this is, I guess, a case of backing a management team. So Ian Murray is the executive chairman of Matador. People will know him from his days taking Gold Road from an exploration through to a $1 billion producing company, and they've got themselves an interesting footprint in what's called the Cape Ray Shear on Newfoundland and the east of Canada, and drilling at the moment. So we're expecting news over the next few weeks, probably 4 or 5 weeks' time. We'll hear some early results. They already have a resource. They already have released a very early scoping study. It does look commercial, but we're looking for some significant resource upgrades over the next 18 months to 2 years as they drill out a very prospective area.
So Matador's a spec. So just recapping the gold calls here. So Newcrest, Evolution, Northern Star, like all three, and MZZ and GPR in the more speculative space. We'll kick over onto iron ore now, and iron ore has obviously been a hugely topical. Fortescue's come out recently and paid a very nice dividend. The market's clearly got iron ore prices wrong in the last little while. Consensus has been chasing their tail for the last 12 months, 18 months. How should we think about the iron ore price going forward, Peter?
James, the second actionable idea or tradable idea we've got is iron ore, but it's not a buy idea. It's actually what we term it as fade the current iron ore price rally. So we're not a believer of this longer term, but to your point, the markets have been chasing the iron ore price for 5 years. The market's been continuing thinking that it's going to head back towards the 50s, and it has at times, but it's rallied. Now, the particular event we're in is more about supply, with a little bit of a sweetness about demand as well, but it's more about supply. So there are a lot of red flags building across the iron ore space, which we need to be aware of. And I guess I draw our attention to lessons learned from 2018, when 3 different companies in 3 different commodities in the mining space, similar backdrop to Fortescue, paying fantastic dividends, great yields, free cash flow and dividend yield, franked dividends, buybacks, special dividends, and the market loved them. Was it going to go on forever? We are in commodity stocks, and the key word there being commodity. They're not rare, they're not scarce. So be aware, do not buy a resource stock for dividend yield. Buy it for the idea and get that as a consequence, but don't buy it for that. So where's Fortescue going? It'll follow iron ore price, which is the really dumb answer, but that's what will happen. So as long as iron ore price stays high and we keep chasing, it stays higher.
I've always been taught to buy resource stocks on high PEs and sell them on low PEs.
Correct.
Is that?
It's now getting to a PE which is potentially 5 times, and that's one of the many red flags I see, whether it's China port stocks, China steel stocks, Japan steel imports, iron ore shipments, a whole range of reasons why it's coming to a head. Have I been wrong for the last month? Absolutely, but it's a fine line between being right and being wrong in this case. So we like the company, like what they're doing, like the cash flow they generate. We just caution $19 very much reflects everything you're getting. And if you're chasing dividends from here, you'll probably be disappointed in the next 2 years.
So what do you think, what needs to happen? If iron ore stays higher for longer, Fortescue is going to keep printing cash, and BHP and Rio are the same. Does it continue higher if iron ore stays where it is? Or does it need a rising tailwind?
It will follow the iron ore price. If the iron ore price stays higher, it'll remain at these higher levels. So Fortescue, if $125 iron ore price for next year, that's where it stays. $19, $20, $18.
So what's consensus for next year, and what's your iron ore?
Compared to what we call a spot scenario of earnings for the current year, which would see earnings a little bit higher than they were last year, just reported. The market number is probably about 3/4, 2/3, 3/4. That mine's just a little bit behind that. So we're all expecting a pullback this year. And could I just remind you that last year in July, the iron ore price was at a $125 high. The following month, August, the iron ore price fell $40 per tonne to $80. So when these red flags kick in, and I should stress that the exchange in China, which drives this, called the Dalian Commodity Exchange, is largely driven by inflows from investors, not from traders, consumers, producers, consumers. And on that basis, it can be quite volatile.
So what are you calling Chinese speculators?
Absolutely. And look, they're like we are talking about now, it's about momentum, and momentum's a different kind of trade, and the Dalian exchange is very much momentum based, which is fine because at the moment we have tight supply, reasonably good, robust demand out of China, but we need to be aware. I need to call out very clearly the iron ore price is not cheap. Is it going to roll over tomorrow? Probably not. Is it a month away? It could be. And at $19, you need to be thinking about fading some of those shares into this rally, because if I didn't tell you that, that would be remiss of me to do that.
Yep, I completely understand that. The other thing I picked up on Fortescue recently, the amount of money they're going to be putting into the ground over the next 12 months. They've got a big big CapEx bill likely in the next 12 months.
That's a good point. So that's a good thing building, because it means a company will get bigger and better in the longer term. But over the next 2 years, they're sinking more into the ground to do that. So their dividend probably won't have the same flex as it had last year. So all things being equal, same profit, the dividend will be lower anyway. And that's probably another warning sign just to be aware of, that if you're buying for a dividend, be careful.
What about BHP, Rio, the large guys in the space? Obviously, they're more diversified, etc. Haven't run as hard as Fortescue. You're still positive on both of those, but less so given the backdrop for iron ore prices.
We are absolutely, given what I've just said, but we're also saying on Rio, fade Rio. It's 96% of its earnings this year are iron ore. It's almost like a Fortescue, just bigger. So it will track the iron ore price as much as Fortescue does. BHP's caught up kind of in the functions of, it's about 60% iron ore. It lags as an iron ore play on the way up, it'll get sold down on the way down. So it's kind of caught in the middle there. It's doing fine, and it really shouldn't be dragged around as an iron ore play, but it does. So if the market sells off in iron ore, it will drag Rio down, Fortescue down, and unfortunately BHP will be slower, but it'll drag along.
The other offsets, we'll get the copper in a sec, which is another key area for BHP. What about the smaller area in the iron ore space, Andrew? I know we don't cover a lot in the iron ore space. There's not a lot of smaller iron ore companies listed here on the ASX, or correct me if I'm wrong. Mount Gibson was one that I used to look at. What are you seeing in the smaller area of the market?
Yeah, you're absolutely right, James. It's not a lot, and it's because iron ore tends to be big cap territory. I mean, it's a bulk commodity. You need to do it in scale. You need to have the Pilbara machines that a BHP, Rio and Fortescue have to really drive your costs down and run businesses that are profitable through the cycle, which doesn't mean that you can't make money at various times. I don't know if you cast your mind back to sort of 2011, 12 type time frame. There was a raft of small iron ore guys who all sort of got into the market, the Atlas Irons of the world and the Jindalbys and the Mount Gibson, who are still around. Mount Gibson, they're producing iron ore from Koolan Island, which is in fact is Australia's highest grade iron ore mine. It's a very high grade. Therefore, you can make money through the cycle a bit more than some of the lower grade operators. But most of the low grade, or most of the small iron ore producers in Australia are lower grade, and they delivered cost up to China means that they don't really make money when the iron ore market's back at something in equilibrium. And I agree with Peter. Obviously, the iron ore price has surprised all of us how well it's holding up, but $120 a tonne iron ore price is not a normal iron ore market. Most people would use $60 a tonne-ish as a mid-cycle type number. And how long we get there, I don't know. But 3 years from now, the small guys won't be making money.
Yeah, which I guess that was, you mentioned Atlas Iron. So didn't Gina take that Atlas Iron out? Right at the cycle low.
It's a good name to remember, because that was the poster child of the last cycle in iron ore price in 2011, 12, 13. And it was very high cost, very highly leveraged, and made a lot of money at the time. And I think it traded a high, from memory, of somewhere in the $3, $4 market. It sold out in the cent range. So be careful what you buy. If you're buying leverage at the top of the cycle, that's fine, but just be aware of what you get buying into. You
were talking about they're dominated by the large caps. I guess that's because of the nature of the business, digging dirt out of the ground in a really economical way. Didn't Atlas Iron used to truck their ore out?
They were trucking, yeah. And Mineral Resources effectively doing what Atlas was doing back in 2010-11. They're a high-cost producer. They're the marginal player.
So just on Mineral Resources, I know we're going off topic here, but they were in the press yesterday. They've obviously had they've been ripping higher. They're looking to increase their level of production going forward. They're obviously involved in the mining services and contract mining side as well. Any thoughts on?
They've been a two-trick pony, so they were a lithium play when lithium was running, and they
did a good deal.
They're very well positioned, and they did a very good deal. They've been in the iron ore space via contracting, and now as an owner. They're a very, very competent mining company, as both a contractor and a mining company. They do things very well, but the asset base they have is that higher cost base. It's doing very well now, and in moments like this, you want to buy the high cost producer because they're the most leveraged. Mineral Resources is probably the highest cost producer, the most leveraged in Australia. So hence they're going up, and they're also coming index inclusion, which is helping them at the moment as well.
Tomorrow?
Potentially. So, yeah, so that's been part of it. But they're the ones, as Andrew said, 3 years' time, how does their cash flow look? Not quite necessarily as good as what it does some of their peers do. So.
All right, thanks for that. So just in terms of the iron ore space, so fading iron ore, so less bullish, bearish, fading it, not knowing that the top is here, but being on the sell side rather than the buy side.
I think the top's here. We just can't pick the right day. So we're just in that basis as an investor. I need to start letting some go now. And
so what do you? So just on that. So where does that flip the side? Like, what's the? Is it iron ore at 80 a ton? Is it iron ore at 100 a ton that starts to change that mentality?
Look, we did a curve the other day of oil price versus iron ore, and oil's at 40, iron ore's at 120. They both should be about 80. That's where they're headed for. So iron ore is going to fade to 80, oil's going to rally to 80 over time. So that's the trade. And when it gets somewhere around those levels, you go, yeah, that looks really interesting again. That's getting back to a value proposition which is sustainable. All
right, let's keep moving on. Nickel has been a pretty hot commodity over the last little while. It's been very strong. You think about the demand backdrop, being pretty strong coming out of batteries, etc. Andrew, what's your take on nickel? What does the supply side look like here in Australia and more globally on the nickel area?
Yeah, look, the nickel market's been obviously over a long period of time been a very volatile market. It's a market that is prone to supply shocks and price spikes at various times as the market gets out of balance. And I think our view 3 or 4 months ago when the price was down at $12,000 a tonne, it was probably an unsustainably low level, and we're not surprised to see it back at $15,000 a tonne now, which is coming back into something that would be more mid-cycle. There is every chance nickel heads into what we would call an incentive pricing environment again over the next couple of years, where you will see nickel prices, similar to iron ore, trading well above the cost curve as an environment where demand is strong, supply is not there. You need a high price to incentivise new production. The supply side of nickel is dominated by Indonesia and the Philippines. So Indonesia's about a quarter of the world's nickel production, and the Philippines is about 20%. So between those two, they've almost half the world's supply. And what you've seen in the last 10 years is sort of on again, off again export bans from Indonesia, which have caused ripples through the nickel market. And we had another one of those last year where they brought forward some bans to January 2020 that were originally scheduled in 2022, and that caused some ructions in the nickel market as well. The demand side, you need to remember, everyone gets caught up about batteries, and batteries are still a very small part of the nickel story. 2/3 of nickel goes into stainless steel. Only about 5 or 6% goes into batteries at the moment, but clearly the growth that's going to come from the battery market is what everyone's excited about. And there are two types of nickel out there. There's the nickel pig iron from the laterite nickel deposits that get produced out of Indonesia, and then there's nickel sulfide, which is easier to convert into nickel sulfates for the battery side. So supply is going to have to ramp up. There are a few companies around that are trying to ramp up supply. The demand story is going to be very strong in the next 10 years.
Just on those companies, Andrew, we don't have a huge number of pure play nickel producers on the ASX. Can you name a few and give us some thoughts on them?
Well, there's obviously a couple in Rocky's space. Independents and Western Areas are both very leveraged to nickel. In my space, we cover two. We cover Nickel Mines and Mincor, which are two exceptionally different companies. In fact, the only thing they've got in common is that they produce nickel. One is a nickel developer of a typical nickel sulfide deposit, and the other is a nickel pig iron producer in Indonesia.
What's your view on the stocks that you cover in your space? Nickel Mines seems like it's been on a pretty strong run from March lows, gone from 30 cents up to 70 odd.
Yeah, look, Nickel Mines is a fascinating company. It's one that at first impressions, when people look at it, there's concerns about, obviously they're in Indonesia, they're in partnership with Tsingshan, which is the world's largest stainless steel company, a Chinese company. And, there's always that sort of concern if you're in partnership in Indonesia with a Chinese company, are you going to have the rug pulled out from under your feet at some point? But you need to understand the background to how they got there and what's happening in Indonesia. Now, Tsingshan are the poster child, if you like, for what the Indonesian government are trying to do with their export ore bans. Tsingshan has built this incredible stainless steel processing facility in Sulawesi. They've spent billions of dollars building nickel pig iron producing facilities in stainless steel capacity, and doing everything the Indonesian government wants them to do. So they are, they're very much in the good books with the Indonesian government. And then nickel mines, who were supplying them with nickel ore for that facility, have come to an arrangement where they're taking ownership of some of the nickel pig iron reverse rotary kiln and electric furnace units that are being built there. And in exchange, Tsingshan have a 19% stake in nickel mines. So I think the relationship there is very symbiotic. The private family behind Tsingshan, I think, see nickel mines as a way for them to get cash out of Indonesia and cash out of China. You've seen that recently. The nickel mines result this week, maiden dividend paid, first cash coming out of the country. Some of that's going to end up back in the pockets of the Chinese.
And they're not small, Andrew, are they? They're a reasonable size operator.
They're 1.4 billion market cap. So, they're certainly, they're not a micro junior cap, not a small cap. They're a mid-sized company. And in fact, if you look at what they've just done, they've just increased their ownership of these assets to 80%. And so their share of the nickel output from that nickel pig iron producing facility, it will be around 32 to 35,000 tonnes per annum, which would actually make them the biggest pure play nickel exposure on the ASX.
Thanks, Andrew. Now, the larger cap space, Peter, we've got two, as Andrew may mention of, Independence Group, Western Areas. Independence Group's got gold, though, thrown into the mix. What's your take on both of those?
It was interesting you mentioned independence with gold and nickel. We like gold, we just mentioned that. And although I don't like the confusion of the two commodities, it's extraordinarily well placed for the next couple of years, because we like the tailwinds in the nickel segment with the comments that Andrew made, as well as gold. It's quite an interesting mix, but the one I like because it's pure play. If I want to buy nickel, I want to buy the pure play leverage company, that's Western Areas. And I like it for a range of reasons, but one is in particular, it's in a very similar position where a copper company peer called Aussie Minerals was about 3 or 4 years ago. That is, the market's only looking at its short-ish mine life, the perception they've got a short life, not really giving them any credit for what will be their next production from a project they're building now. So they're discounting perceived short life production, not giving value for future production. It looks cheap. And it's underperformed like its peers other than nickel mines since early July. And it's sitting there. It's not a 3 to 4 to 5 year company. It's going to be around into next decade and probably the end of next decade. So the 230s into 240. So it's not got a 5-year tail. It's got a 20-year tail. It's a very big difference in valuation. So we'll run. It's in the segment of the market, which is what we call sulfide and nickel. And to just add to what Andrew said, there are two types of nickel. The battery market can only take a sulfide-based product, either from a mine like a Western Areas, or it has to be processed from the likes of Indonesia. So Western Areas has the right product, and they've got the right feed into that market. So I like the end product development, but more importantly, their breadth of production they've got for an extended period, and their ability to self-fund it with no debt. They've got net cash, and their cost base is comparable to their peers. So a good balance sheet, well run, good outlook, undervalued by the market at the moment.
So yeah, the undervalued by the market. I mean, you look at Western Areas on the screen in front of you. You can clearly see the price action there. IGO is very similar as well. That it's got gold price tailwind, nickel price tailwind. Yet they've been under pressure in terms of share prices. We're all about trying to make money out of the market and looking at what's going to be the catalyst to get these stocks higher if you don't have that movement from the backdrop of commodity price tailwinds.
There's 5 Australian nickel names, so Independence, Western Areas, Minicor, Panoramic, nickel mines. 4 of those have underperformed since early July. So the Aussie dollar nickel price has continued to move higher from its low in March, and those 4 names have not. Nickel Mines has, and Andrew's given you a view on Nickel Mines. That gap typically doesn't stay open like that. It closes, and that will close. I can't give you a catalyst right now what will close that, but that will close.
So just to give you some background, I remember having this discussion with Peter about iron ore versus Fortescue back when Fortescue was trading at around the $1.50, $1.60 a share, about Fortescue being very cheap. You're one of the more bullish analysts on the time. So just to give you some backdrop into Peter's call, is a little bit contrarian in times, and I think that's one of the things you need to be in terms of being an analyst in the resource space, not following the herd. You put yourself out there on the side, and that's clearly what you're doing in terms of nickel stocks at the moment. So Western Areas, what's your price target? And you're obviously
valuation's $3, and I was just actually updating this morning post some news they put out yesterday, and that's a very comfortable $3 valuation. So I set my target price as $3 a share because it's an easy target to have. But in a nickel price tailwind environment, stocks don't go to their fair value like we see in Fortescue. They go way beyond their fair value. And typically resource shares trade 30% above, 50% above. Fortescue, on our estimates, trading somewhere close to 70, 80% above its so-called long-term fair value. So nickel stocks will do that. Through the cycle, they trade well above value, and at the moment they're trading below. I like to look at these things and below fair value. What will make it turn? Nickel price is the obvious one. Operational delivery is another one, and this project, as it comes on over the next 2 years, the market finally goes like Oz Minerals lately. Oz Minerals has put on 40% in the last few months.
We're going to get to that. You're jumping ahead, Peter.
Sorry. But that moment where people go, wow, you've done it. You've actually delivered. And I call it backward-looking pricing. Sometimes the market won't pay for what's going to happen. They do it in open pay in the buy now, pay later sector, but they only pay in resources for what has happened. And that's typically the case for companies that have been around for a while. So you'll see that delivery would be borne out in share price gains going forward.
So you made mention of Oz Minerals, and this brings us into the copper market. Oz Minerals has done particularly well. This is one of our biggest positions across our portfolios. We've done very well out of it. Are you still bullish in terms of? I'll start with copper, then we can dig a little bit further into Oz Minerals, because obviously the copper market has been an interesting one over the last couple of years, but to me it's just broken out. It looks really good.
Yes, we are, and copper's benefited like iron ore from supply. So there's been an enormous amount of supply, COVID-related supply cuts in Latin America, from Brazil through Chile, Peru, and that's impacted the supply side of the market. That's been played out in China, which has been buying a lot of material, like in iron ore. We're seeing price premiums squeezed higher, inventories globally lower, and that's taking price higher. So yes, it looks to have broken out. As that supply comes back on, James, I think we'll get back to I call it a normal price, probably around the $3 US per pound mark, which it's near now. But it's broken out of that range. It dropped into where a lot of people got very bearish in March, saying copper was going to $2 to $2.50. It's now very clearly going to be around that $3 plus or minus level going forward. And that's very positive for our numbers of these likes of Oz Minerals.
Yeah, there was a lot of concern about the copper market being oversupplied going into 2021, 22. What's the case?
Look, there's a lot of elasticity in copper. One of the narratives is always there's a shortage of supply, grades declining, not as much available copper, and there's nobody looking for it. Copper seems to keep coming to the market. So it's been a fairly well-balanced market, and it's been squeezed in the last 3-6 months because of COVID-related supply cuts. So there will be some normality there, but at the moment we're on the right side of that pricing.
Okay, so tying it back into Oz Minerals, which is your key copper call on the ASX, it's done spectacularly well from the lows in March. They've been delivering operationally for a reasonable amount of time now. The last 5 years, they seem to have turned that ship around.
I think it's worth making that point. 5 years ago, $3 a share, the market hated Oz Minerals. And to my analogy about Western Areas, short mine life to 2020, 2022, didn't believe the project they were trying to build called Carrapateena. What have they done in the last 5 years? They've delivered 5 years of production and added another 10 to 12 of their existing operation, so a lot longer life. And they've brought this project on called Carrapateena. And the company's now not 6 years life, it's decades long. It's probably going to be 50 years plus. Huge tail, well run, well delivered, and a net cash balance sheet. So tick to all of those things, and it's got the copper price tailwind in the short term. Wrapping that all together, love it. Love what they've done. I think the CEO is one of the best in the Australian mining market. It's not looking cheap at the moment, James. I think it's got some tailwinds behind it in the short term, but at the moment it's looking like it's getting almost to a Fortescue stage where I'd probably start letting a few go. It's worth somewhere around the $11 range. It's currently trading at 14. As I said, things can stretch higher with the right tailwind. It's starting to look a little bit full. So
that fits our thinking. We've let a few go across our portfolios in the last couple of weeks, but holding a reasonable position going forward. Because I do agree that it's got a lot of leverage to an improvement in the copper price. I actually think the copper price looks pretty attractive here at these current levels. Andrew, what are your views seeing just in the smaller area of the copper market? Is there anything that you're catching your eye?
Yeah, look, it's actually very difficult in the small end of the market to find copper, and that's part of the reason why people talk about looming supply deficits. There's not a lot of exploration going on. There's always some sitting within BHP and Rio at the moment, where they've got some interesting projects, but at the small end, not a lot. One that has caught my eye that we haven't done a lot of work on yet, but I met with the company recently, and it looks really intriguing, is Staveley. Staveley Minerals have they're looking for a porphyry in the Staveley project in Western Victoria, and in the process of trying to find the porphyry, which they haven't actually discovered yet, they've identified a whole lot of shallow, reasonably high grade copper towards the surface in these sort of almost magma style deposits. Magma mining back. Peter will remember them from BHP acquiring them in the 1990s. And so, look, Staveley Minerals might be one that if people are looking for they're not producing yet, they're a long way from production, but it's a very interesting exploration play in copper.
What did they do? They had some good hits at the back of 19, Andrew.
They did, and they've had some good further follow-ups of that this year as well. So, if you go to their website and have a look, they've actually got quite an interesting animated video that you can have a look at to see what they've been doing and what they're up to. It looks quite intriguing.
One thing I just wanted to bring you back on, Rocky, was the concept of quality versus value, and whether or not we should be looking down looking at the cheaper areas of the market. So Sandfire is the company that springs to mind about value, but they've had operational issues. They've got a reasonably short mine life. The market's concerned about that. Is it all too hard? Should we stay in the value side, or is it the Sandfire? In the quality side, or does Sandfire actually represent value?
Good question. But firstly, I just push back and say operationally they've been not too bad. And I'll come to that, but they do screen well for value. And to me, when I see something that screens well for value, it raises my attention, and I want to dig in. I want to look further. So invariably, they're cheap for a reason, and it could be operational, it could be financial, it could be commodity markets, it could be a project, and you need to understand why they got there and how they can get out. That's when you take the value, you can start mapping out a pathway and catalysts. So let me put to you about Sandfire. Its current market cap is about 900 million, 880 million. It's got cash on the balance sheet at 300. Over the next 2 years, it'll generate free cash flow from its existing asset of 600. It has 2 development assets in its portfolio. One is listed in Canada, which has got a market cap of 200 million, so it's effectively liquid. And another asset they bought in Botswana in Southern Africa mid last year, and they paid 170 million. They bought that at a deep discount to NPV, so call it 250 million worth. The company's potentially sitting on value of cash, free cash generated in those 2 assets of about 1.3 billion. It's trading at 880. That catches my attention. So yes, it has a short mine life in WA, and they've not been able to add to that yet. But as per gold producers, Andrew mentioned a bunch of names. No gold producer has typically had more than 3 years life, but the market keeps valuing this and able to find something. Sandfire will find more of what they call these pods of copper where they've currently mined. They haven't found one large enough yet. So they're going to tickle on there for a little while yet, but it's where they take the company from here. And I like what they're doing. There could be a little bit of a gap in production, which is what probably the market's partly marking down. Free cash flow is substantial there. Their capex goes to basically nil for the next 2 years. And if you like the copper price story, which you just did, and it's got gold as 20% of its revenue, it generates a lot of cash that can do things in the next 2 years, 3 years.
All right, so we'll Sandfire's the value pick in the copper space at this point in time. We're going to move on to mineral sands, because I reckon this is actually a pretty interesting area at the moment. Just obviously large cap, Iluka, but we've got a couple of interesting small caps in the mineral sands space. Andrew, you're one of those that you you've written a few research notes recently on a company called Strandline. STA is the code for that. Take us through the thesis on Strandline.
Yeah, look, Strandline's actually been my top pick for most of this year. We initiated coverage on it at the start of the year. They were down around sort of 10, 11 cents, and obviously they've had a really good period. The management team are executing exceptionally well, and just been a string of positive news coming out of the company in terms of getting this project up and going. So what they're doing is they're developing a project called Coburn. It's a project that's been around for a long time. It was discovered in around 2000 from a previous company called Gunson Resources that people might recall. Gunson sort of morphed into Strandline, new management team. The guys who are running it are all ex-Sedgman. They know how to build things. Luke Graham, the CEO, and Peter Watson, who's an executive director, both ex-Sedgman. And they're executing exceptionally well. So it's a big project. So unlike a lot of the junior mineral sands projects, which tend to be relatively short mine life, this is going to be a 40-year+ project. It's big. It's going to be producing around 5% of the world's zircon. It's about 10% of the world's global ilmenite, chloride ilmenite. So big project. Where they're at is that it's a $300 million capex build to build it. They've got funding coming from the government. So the NAIF facility, the Northern Australian Infrastructure Facility, is going to fund half of it. They'll need some equity, probably around $80 million of equity all up, and the balance in project finance. They've got most of the product in very strong offtake agreements with global customers, and these are big names. So DuPont is going to take all the ilmenite. Industry Potosi, which is one of the biggest ceramics manufacturers in Europe, if not the biggest, is going to take the bulk of the premium zircon. So these are very strong offtake contracts with major players. I think there is also potential for one of the customers to get involved strategically with the company as well. They've got the rutile offtake still to be signed. There's a couple of positive catalysts coming up in the next few weeks. The rutile offtake agreement, which is about 20% of the project revenue, and that may well come with the customer with that taking some equity in the company. And then the next thing they'll announce will be the project finance facility, which they're in the final stages of dotting I's and crossing T's on, and then the final bit of equity will come. So I think, as you pointed out, we've got a price target on this stock now of 52 cents. So well more than double the current price, and frankly, that number is very conservative. If you look at where mineral sands pricing is today, zircon and rutile pricing, and for those who aren't familiar with those two commodities, zircon is predominantly used in the ceramics industry. It's the glaze on tiles and on porcelain, and rutile is a TiO2 feedstock. It goes into the pigment industry, largely used in paint, paper, and plastics as well. Some chemical usages as well. And those two commodities are trading at pretty high levels at the moment. So you've got zircon up around $1,350, $1,400 a tonne, rutile likewise. At those sort of numbers, this project will be generating enormous cash flow. And in fact, there's an industry group called TZMI, which the industry generally relies on for price forecasting. If you use their price deck in our models, then this stock could be worth well north of $1. So we actually, Peter and I have a much more conservative view of where mineral sands pricing trends in the next 2 or 3 years. We use a more conservative set of numbers, and even with those more conservative numbers, we're getting big prices on this stock.
So they're in WA, Andrew?
They are. They're just north of Geraldton. So in fact, the product which they'll ship out will go out of the port of Geraldton, and they'll go straight past Iluka's operation at Nungurlu. So there is some speculation that Iluka could still get involved in this project in some way.
Someone's listening to you and just ticked over the price up to 23.5 cents there, Andrew. So in terms of, you mentioned Iluka, Rocky, what's your take here? These guys have obviously got an interesting next month or so. I think they go to a vote in October or to shareholders about spinning out their iron ore royalties, etc. What's your take on Iluka at the moment after a pretty decent run up from $6 in March to $10 now?
So just to flesh that out, because it's a mineral sands company, as Andrew described, it has the tiles and toilets and paint kind of exposure via their products of rutile through zircon, and it's a lead player in the market. Globally in zircon, it's number one, and in rutile and products, it's number two after Rio Tinto. So it's a big player, and it's been around for decades. I've analysed it for decades. It's a deeply cyclical industry. It comes and goes. It has some really good times. But the other part of the industry, which we've been looking at for 2 decades and waiting for this to happen, is the spinning out of a royalty they have over a BHP iron ore mine called Mining Sea. There's discussions about this started in 2003. It's finally coming where they're going to spin this out. It generates at the moment about $50 million of EBITDA for the company. It's no exposure to operations, it's just purely revenue royalty. So every tonne BHP pumps out of this mine, they get a clip on that. Now the mine is expanding, so it's about to double in size. So even if the iron ore price halved, volumes double, revenue could be the same. So long term, really like 30, 40 years of 50 million to maybe $100 million per year. It's not a bad royalty. So that's worth the largest part of the company at the moment. So it's a $3 billion value in terms of the market cap, and about $1.6 billion to $2 billion, depending who you look at in the market, how they value. That's what the iron ore's worth. So the mineral sands is not worth a lot. In fact, if you assume that the multiple evaluation Fortescue trades and apply that to Iluka, the mineral sands business is only worth about $500 million, which is just absurd. So one part of that company is extraordinarily cheap, either the mineral sands or the iron ore, or both. Iron ore is about to spun out, so the information.
So that's gonna happen. Yeah. Is Iluka going to retain some of it, or going to spin the whole lot out?
They will. So the information book comes out in September. Vote in October. Should be trading, all things being equal, in November. Could be a little bit of delay with the Australian Tax Office. So it'll trade with a stub owned by Iluka, about 20%. They need that for their own financing to cover their own balance sheet. But they'll have some sort of escrow on that for an extended period of time. But 80% will be a free float, and it'll trade as a royalty company. And royalty companies have typically traded differently to mining companies. They're a different beast.
All right, so Iluka maintaining the
that one
valuation.
ahead of the spin out. I think you've got to be there, because this unbundling will see the market more accurately value the iron ore. And as I mentioned, I think even the mineral sands is too cheap at the moment, given that. So it could maintain that points in. What are we all doing at the moment? Because we're at home, we're all renovating. So we're all painting, doing bathrooms and kitchens. So it's ironic that in this environment, you wouldn't have thought renovations would have been key, but globally, be it North America or Australia, there's a lot of renovating going on, which ultimately benefits the likes of an Iluka.
Yeah, huge, and we've seen it through the numbers here in Australia, and you look at the companies that have got exposure in the States as well. Some of Reece, Reliance, companies that have done particularly well this reporting season. You're seeing some really strong growth over in the US. I'm going to throw over to both of the guys now, just to wrap up with the main concepts, just around what else is looking interesting in their space. Is there any other stocks? And I'll start with you, Andrew. Is there any other stocks that you look particularly interesting at this point in time? In your coverage?
The commodities we haven't covered, James, which I think do look interesting, and I absolutely agree with Rocky. You buy things when they're low, and you sell them when they're high. And two commodities at the moment that are trading right at the bottom of what you would see as a sensible range is coking coal and uranium. Coking coal, $115 a ton, I think, Rocky, it was overnight. 135 would be a sensible long-term price. If you look at the last few cycles, you've seen prices above 200 at times, even up to 300 and coming out of the GFC. So I reckon buying coking coal exposure right now is a sensible thing to do. And there is one stock that we look at that's a long way away from producing coal at the moment, but it's sitting on an incredibly high quality resource, which is Atrium Coal in Canada. There are a whole bunch of small coking coal plays around the North American region you can have a look at, and they all look interesting. But Atrium, to me, looks outstanding value. And for those who love to play neurology, Gina Reinhardt through Hancock bought out their next door neighbour, Riversdale Resources, last year for nearly $750 million, which just apply that multiple across to what Atrium is sitting on, and Atrium's worth 10 times its current share price. So incredibly high quality resource. Whether Atrium actually end up producing coal from it, I'm not sure. I suspect they end up getting bought out by one of the big players at some stage. And then the other one I mentioned was uranium. The uranium price has had a few false dawns in the last 3 years. It's obviously been in the doldrums for a decade post the Fukushima accident in Japan in 2011. And it's had a few moments where we thought it's coming back to life again. This might be the year. Fingers crossed that the industry is getting itself back on track again. The general view out there is that the uranium price needs to be over $50 a pound US to have the industry in a sustainable level. Well more than half the cost curve doesn't make money unless we've got the price at those levels. And the spot price took a real sharp step up in March, April this year as a result of COVID shutdowns, and then the big players like Cameco and Kazatomprom coming into the spot market to buy volumes. That process is not over. I would expect to see the Kazakhstanis back in the spot market in the sort of September, October timeframe, and there is every chance uranium does get to that $50 a pound level at some point in the next few months. And so there is a number of ways that you could play that into the Australian market. The one that we particularly like is Paladin, because they do have a track record of producing from their Langer Heinrich operation in Namibia. And when and if the time's right, they'll restart operations there, and that looks really cheap at current prices. But you could also have a look at companies like Boss Resources or Bannerman, who also have uranium projects.
Just on Paladin there, Andrew. So you made mention of the price being right to restart their operation. What's that? That's still the sticking point, the ticking point they need to get to incentivise that restart of
so the uranium market's an incredibly opaque market. Very hard to get a good read on exactly what's going on. And part of the problem is that not a lot of uranium gets sold in the spot market. It's only about 10% of the market. Most uranium is sold in long-term contracts negotiated between utilities and producers that you don't really see the details on. And what Paladin are being very clear at is that they need to be able to sign contracts with the utilities at a price above $50 a pound with duration of 5 to 7 years on those contracts. And when and if they can do that, well, then they'll be set to go. Their cost of production will be around $30 a pound. If they can sell it for $50, $20 a pound, they'll be producing 5 to 6 million pounds a year. So $100 million of cash flow a year will underwrite the restart at Langer Heinrich, but they need the security of those contracts. The utilities won't sign those contracts until and unless the spot price is at a level where it incentivizes them to do so. So that's why we watch the spot market. And I think what you'll see is the spot market getting up into the 40s, $42 to $45 a pound will be a high enough price for the utilities to come back to the market and sign contracts above 50.
So a heap of potential upside if the uranium price keeps ticking. Rocky, what have you got in your interesting bucket?
So James, my third actionable idea, we've talked about gold, we've talked about iron ore, one on the long side, one on the short side. The other actionable idea is another long idea, and that's energy. Energy as a complex, all energy. Andrew's already mentioned uranium, but in that basket of energy, oil, gas, coal. Okay, and Andrew's also mentioned metallurgical coal for steelmaking. That's still a unit of coal. Energy as a group of equities and as a commodity is the cheapest in terms of value and also performance. So if you're looking in that corner of where do I look for things that look interesting and look for a catalyst, it's energy. So my idea is energy. So beyond any ESG issues you may or may not have, and clearly some people do, and I understand that, but these equities look cheap. So I'm now talking from a purely value perspective, but within my area of coverage that fits in that energy space would be a large cap miner called South 32. It's got a large amount of metallurgical coal Andrew talked about, so it's more about steel making than it is about energy generation, but it has an exposure to coal. That looks cheap as an equity, and it's got a good commodity mix for the way we see the pathway forward. And another way to think about energy is the world has slumped over the last 3 to 6 months with COVID. We're all staying at home. We're not using our cars. We're not using energy as much. Industry's been wound back. As the world recovers, which it will, we're seeing that in data every month, the world needs to move. The industry has to restart. It needs energy, and that energy comes from oil, gas, coal, uranium, and the prices will go higher. Oil took a step down dramatically because of OPEC/Russia issues. That's a whole separate supply issue. Demand fell because of COVID. As they recover, things will find an equilibrium. As Andrew said, I like to look for commodities trading below fair value, and all energy commodities are trading well below fair value. I talked about the oil versus iron ore trade, 125 versus 40. They both should trade at about 80. So in that group, ones I cover, South 32, Whitehaven is extraordinarily cheap, needs a few things to happen in the next few months for that to turn around, but I think it will. And areas we don't cover, New Hope Corp and Coronado Coal, they're all in that deep value category, require a tailwind, and I think that's coming. All
right, I'll be quick. Andrew, what's your number one pick? Just pick one stock that you would are most bullish on here.
James, I'm going to refuse to give you the kiss of death on the number one stock. So I'm going to give you four, because it's across 4 different commodities, and I like them all. And if I just pick one, I'm sure it'd be the kiss of death. So I'm going to give you Strandline for mineral sands. I'm going to give you Atrium for coking coal, Paladin for uranium, and Geopacific for gold. They're my top 4 in the juniors.
Great, thanks, Andrew. Rocky, 1 or 4, what are you going to go with?
Look, I'm just going to go with one because consistent with what I just said. Energy looks extraordinarily cheap. So if I take a 1-year view, 2-year view, will Fortescue be at $19? No. Will an energy stock be substantially higher than where it is? Yes. So I'd put energy in that basket and say, buy an energy stock. I'd give you, because I cover it and it looks extraordinarily cheap, Whitehaven. But again, if you've got ESG issues about coal, think about an oil stock or a gas stock. But that basket just looks incredibly cheap. And if you can filter for financial issues, balance sheet, and get comfortable with those and operating issues, Then you just got to wait for an appropriate tailwind, which will come with global recovery whenever we get the vaccine you talked about earlier. Energy is a place to get the most leverage in the next 3 months, 6 months, 9 months, 12 months.
It's a good segue. I'm going to try and do a next webinar on the energy space. So we'll get to some key calls in the energy space there. I'm really conscious of time. We're 1 minute to 1. Just in terms of the questions we got, I think I had about a dozen questions focusing on what's your best pick in the gold space. I think we've well and truly covered that. We've got about 30 questions online. I'll get to a couple of them. What's your view on Barrick Gold in the US, if you've got one? Obviously, if you're bullish gold, Barrick is a large cap producer of gold.
Yeah, so Barrick and Newmont are the two leaders in global gold production. North American listed, Canada in the US, well known, well regarded, lost their way. The entire North American sector lost its way over the last decade, post the last gold price peak. Costs were too high. That journey of recovery has started in the last couple of years. So Barrick now, it's post a merger and it's got a new CEO, which they needed. Barrick is looking really interesting. So I was thinking globally of the two. Barrick probably looks like it could do more. It's got a very dynamic CEO, a South African, who's very sharp, very opinionated, and very good at what he does. So I can't give you valuation metrics, but cost-wise, it compares to Newcrest. It's larger. It's about 6 million ounces of production a year, so it's about twice the size of a Newcrest in Australia. It's in more geographical locations, so it carries more risk. But it's a buy and hold for a lot of the North American funds, so it's going to be a beneficiary of this journey in gold. And if I had to pick one of the two big ones, I think I'd pick Barrick.
So one of the questions, and I've got a few questions on this, is around the influence of the Aussie dollar. Obviously, US dollar has been weak. The Aussie dollar has ripped from 55 up to 74 since March. So how do you reconcile the impact of the Aussie dollar on your gold valuations?
The correlation of the Aussie dollar and gold price is high. So Aussie dollar is going high for a whole bunch of reasons we could talk about at another seminar, because the commodity market will move high with currency. And it seems counterintuitive. You want to buy an Aussie mining share when the dollar is going up. But one of the reasons is offshore investment flows buy a rising dollar. They buy the Aussie market because it's a commodity market. So counterintuitive, but that's one of the reasons. But gold price itself, the slump in Aussie dollar back in March, it kind of was a bit too early because it drove the Aussie dollar gold price to what then was a high. We've now exceeded that, but we almost had our high in Aussie dollar terms too early. So we're going to make high US dollar gold prices. I never gave you a target for this, I'll give you that now, and higher Aussie dollar prices, but you'll find the Aussie dollar is going to hover around 3,000 level, which it's at now, but the US dollar gold price on a straight correlation to real negative rate should get to about 2,500. But with the squeeze I talked about of ETFs, gold's going to make a fresh high, which is probably going to have a high 2 in front of it, or it could be a 3, could even be higher. And that squeeze at the end won't be fundamental, but it's just going to be people getting crazy and manic and doing the fear of missing out trade.
Absolutely. In terms of the gold price in Aussie dollar terms, rallying pretty hard. The gold stocks in Australia really didn't jump onto that rally.
Yeah, it's a little bit like
as much as they could have.
The discussion we had with nickel. There's been this lag, and I call it the jaws are opening up between the underlying commodity in Aussie dollar terms versus the equity, and that gap raises again, it piques my interest. I start digging and start to try and work out why. Some of them have closed, some of them hasn't, but over time those gaps close.
All right, I'm going to wrap it up there. It's 1:03. I'm conscious of the time. I've got questions coming through just on energy stocks, so that's a good indication of for the future webinar. We've also got a couple of questions on the mining services sector with the amount of money that's likely to go into the ground over the next 12 to 24 months. I think that's a really strong topic. It's an area we've skewed portfolios towards in the last little while, so it's a topic we'll get to at other webinars. We've got questions on rare earths, etc., and the list goes on. So I firstly thank the two gentlemen for joining me today. Peter O'Connor here, who joined me in Sydney, who's our senior resource analyst, and Andrew Hines down in Melbourne, who's our head of research. Thank you very much for your insights today, gentlemen.
Pleasure, James.
Thanks, James. Pleasure.
And thanks to the vast majority of people. We had a large number of people online. So I hope you found value in today's webinar. We'll be doing more of them, so keep an eye out for that. Thanks for joining us, and bye for now.